What you do during the lockup will set you up for success when it ends. IPO lockup periods are typically 180 days, but there can be an early release based on achieving a stock price for a certain number of days. You could also receive earnout shares, and there could be a multi-stage release to prevent everybody from selling at once. And if you're a former employee, you may be surprised to learn that the lockup does extend to you. Don't pre-spend the proceeds. You'll want to delay any major purchases. It's tempting, but nothing is guaranteed. Stock prices can swing wildly, especially IPOs, and you don't want your paper profits to evaporate when you have a real bill. The second is make sure you're managing concentration risk where you can. Look at your entire portfolio. If you work for a tech company and your 401k is loaded with tech stocks, you might be doubling down on that risk. Get organized. This is huge. Your stock plan is probably moving from Carta to a new stock plan administrator. There could be a different transfer agent that has your actual common shares. Download everything before that switch happens. Make sure you understand your cost basis. Create a spreadsheet and gather your prior exercise dates. If you qualify for qualified small business stock, if you exercised options when you were in a different state, that can have tax ramifications when you go to sell. If there was a stock split or a reverse stock split, tracking that and understanding how your basis will change. This should be done during the lockup period when you don't have liquidity. So when the lockup expires, then you can finally consider selling. So the first thing you'll need to do is make sure that you understand your company's trading policy. This could be figured out at the last minute. There's a lot for newly public companies to grapple with, and sometimes it takes a little bit longer than you might expect for their finance team to come up with all of the rules, and communication can be a little spotty. So when you're not sure, raise your hand, ask the question. We often get asked, how much should I sell when the lockup ends? Consider four things. The first is your risk tolerance and level of concentration. If you're heavily concentrated, you might have more to lose from a 50% drop in the stock than you do to gain if it were to double, at least in the beginning. The idea would be once you have some liquidity out, you'd be a bit more discerning with the stock price. The second is tax efficiency. Prioritizing long-term capital gains, making sure that you're not inadvertently selling shares that qualify for qualified small business stock. Each type of option or common stock that you have already exercised has a different tax treatments. Look at the entire picture. Dollar cost averaging is the third strategy. So rather than try and time the market, especially for current employees who usually have limited trading periods between earnings releases, dollar cost averaging out of the market can be a great way to sell portions over time and to manage fluctuations in the stock price. And the last strategy is a suite of advanced trading strategies for concentrated stock positions. So this is anything from puts and calls if you're no longer an employee, to ways that you can reduce your exposure indirectly by screening or direct indexing, all the way to exchange funds and other tools like that. This is where a specialized advisor comes into play. At Darrow Wealth Management, we specialize in helping people navigate stock options and sudden wealth from IPOs. If you're facing a lockup expiration or your company is about to go public, let's talk about building a strategy that's right for your situation.